If you use the extraordinarily popular Mint app or Mint.com website in order to budget and finance, then it might be time to find something new because, as you can see right here, Mint, one of the first budgeting apps, is shutting down. Now, for those of you that might not know, Mint was started in 2007 by this guy, Aaron Patzer, who is an extraordinarily successful and currently well-known entrepreneur. And in 2009, just 2 years after having started it, he sold his Mint app, which had become very popular with people who were looking for a simple way to finance from their phones. He sold it to Intuit, which is a very large company, and you probably know them for things like QuickBooks, which is their accounting software, and TurboTax, which is their tax filing software. This is from the blog many years ago. September 14th, 2009, Intuit, that's that huge company, has signed a definitive agreement to purchase Mint.com, a leading provider of online personal finance services, in a cash transaction valued at approximately $170 million. Privately held, Mint.com, based in Mountain View, California, has successfully used its advanced technology to provide consumers with an easy and intelligent way to manage their money. The idea was that Intuit had a lot of money and resources and very smart people, but no idea or concept around finance apps. But Mint had a really good idea and concept around a finance app that they had built and were using regularly to millions of users, but it didn't have the huge money and marketing that a company like Intuit would have. So it was, of course, logical for Intuit to buy out Mint and use Intuit's resources and Mint's actual platform and trust with the user base in order to come together and get Intuit, which was working in not exactly the personal finance space, but a finance adjacent space, get them into the personal finance world. And even though Mint was, and kind of still is, one of the most popular apps, it ran into 3 huge issues between 2009 when it was purchased and today when it's being shut down. The first of these issues was the way Mint was making money was essentially unsustainable. Here's from Monarch Money, who interviewed one of the people who was on the team early with Mint Mobile, and says, most free apps in the App Store have minimal direct costs associated with delivering their service. This is not the case with personal finance app, which typically rely on data aggregators, Plaid, Finicity, etc., to connect tens of thousands of financial institutions to aggregate the necessary financial data. These data fees are quite expensive, which means a personal finance app is losing money on each free user and must make it up in some other manner. Mint's business model was to present users with offers for various financial products, banks, credit cards, and so on, and to earn a referral fee if the user applied for one of those products. Unfortunately, this model was never able to cover our data costs of delivering the service. Worse still, this ad-based business model created misaligned incentives between the company, which is Mint, and its users, because the financial products that offered the highest referral fees were typically not objectively, quote, best products, unquote, for our customers. There was always an internal tension between doing what was in our users' best interests and trying to drive up revenue to keep the business alive. What he's talking about here is basically the straight-shooting legitimate finance companies out there would be happy to advertise with Mint, but they might not have either the resources or the desire to spend the amount of money that a shadier company might be willing to do. So if some legitimate finance company wants to get in front of Mint's users, they might be willing to pay, say, $1,000 for a user. That's just a random number that I picked out of nowhere. But if a shady company that offers a financial service but then tacks on a bunch of fees and then aggregates and sells your data to data brokers or stuff like that, stands to make more money per user, they might be willing to offer $1,200. And then Mint had this internal struggle of, do we go with the legitimate and more reputable financial institution that's not going to pay us very much, or do we go with the one that is maybe a little bit shadier but not technically breaking the law, but that will help pay our bills and keep the business open? This is a struggle not just with Mint, but it's a lot of companies have this issue of this kind of gray but legal area versus just going straight and narrow, but possibly having to shut down the business because of it. Now, I said there were 3 reasons. The second reason was there was a large amount of competition. See, everyone sees the successful startup, and then they all want to be a part of it. Think about like streaming. Netflix came along as this huge and very successful startup, and then that whole system and industry has been ruined now because of people like Disney Plus coming in and moving their stuff over there. You got Paramount Plus, you got like CW Plus, and you got Hulu and Hulu Plus, and everybody wanted a piece of this successful pie, and as a result, it's kind of been ruined for everyone because budgeting is a simple concept and it's very easy to make an app that budgets. It's essentially just a spreadsheet with a slightly prettier interface, and so everyone wanted a piece of that. And if you look at this Business Insider, this is alternatives for Mint Mobile. There are quite a few of them. Quicken, which is actually also owned by Intuit, Honeydew, Monarch Money, Pocket Guard, Simplify, also by Quicken, Rocket Money, which is, I think, a more recent one, but you get the idea. If you want to build a business and budgeting app, it's pretty easy to do so. And most everybody that now handles their finances on their phone, which I'm sure is tens, possibly hundreds of millions of people, probably want some kind of a finance app in order to help them with their budgeting. So all of these companies with huge amounts of money are willing to pour tens, maybe hundreds of millions of dollars into building up their own financial investment app in the hopes of making money later down the line as the users convert to premium or other stuff like that. And the final reason of the three is there was a general shift in strategy from Intuit. Here we can see on this Monarch blog, once again, speaking with someone who was an early engineer or business administration person on the Mint Mobile, on the Mint team. The thinking was that Intuit could offset Mint's losses by using it to funnel more users into TurboTax, which is a massive revenue driver for Intuit. Candidly, I think much of the original Mint team became disillusioned with this direction and left Intuit shortly after the acquisition. That said, it clearly made strategic sense for Intuit, as evidenced by the fact that they kept Mint alive for the past 13 years. Basically, what he's saying is that Intuit bought Mint not so much to have access to the Mint.com platform, but to have the access to the users that are using the Mint.com platform, because probably there's a high overlap between people who are on their phones doing their budgeting and finance and people that would be willing to file taxes electronically with a service like TurboTax. And so every tax season when it comes around, you can start putting your Intuit ads into the Mint Mobile user base and interface saying, hey, it's about time to pay taxes, so why don't you just use TurboTax, which is made by the same company that owns the app that you're currently using. It builds trust and reputation. Essentially, Mint was what we call a loss leader in business, where you lose money on one thing in order to make it back somewhere else. Think about stores sending out coupons when they recently open. They're, 40, 50% off. Probably they're not making money on those specific products, but the idea is that you will buy other things that they make money on, and then you will continue to come back to the store over time, even when you don't have coupons, and they'll make money on the back end, so to speak, in the future, having you as a long-term customer. Now, a little more about this strategy shift, because it wasn't just Mint Mobile, but basically what happened is that Intuit shifted its strategy away from the small-term specific financial stuff that Mint was doing into a larger system, Credit Karma, which they purchased for $7.9 billion. And here's a bit on it. Of course, Intuit purchased Credit Karma in 2020. Credit Karma has an estimated user base of 130 million US users, so it's a much larger platform for cross-selling Intuit products such as TurboTax, as well as Credit Card Karma's bread and butter, which is loans, credit cards, etc., which is extraordinarily profitable, by the way. If you're Intuit, it doesn't make sense to keep investing in both of these consumer platforms, so I'm not surprised they're shutting down Mint and consolidating to Credit Karma. See, with this new app, Credit Karma, which is an app that you can have on the phone, all the relevant features that people wanted and used, they're going to be porting over from Mint in order to get it over into this new Credit Card Karma app. And the hope that they have is that not only will Mint itself be ported over into the app, or at least the features, it probably won't be called Mint inside there, but they're hoping that the users will come over as well. Because frankly, consolidation saves money. Having two apps that run kind of similar features with similar people and possibly having two companies that you have operating under the Intuit brand running those, it doesn't make sense and it's kind of expensive. So you shut down one of them, or like they're doing in this case, you merge them together into one smoother, more profitable, more efficiently run system under the name of the larger and more recognizable one, which in this case is Credit Karma. Because if you think about it, even if not a single user from Mint comes over to Credit Karma is still fine with 130 million users. And because Mint wasn't making anything anyway, it's not exactly a loss for Intuit to shut it down, even if they lose every one of those Mint customers going forward. However, with how popular Mint was and looking to the future, this has left a pretty interesting gap in the market. If you look at just a simple Google search, well, sort of a Google search, I use the Brave browser, for Mint alternatives, there's lots of articles over here by people who have their own financial institutions advertising on blogs who have their own Mint alternative that they've already had for a while, talking about that competition from earlier. But Dough Roller, Software Testing Help, blah, 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 Personal Finance, Money Patrol, so on and so forth, Credit Donkey, excuse me. All of these institutions have their own app that they're trying to get the Mint users to port over to, because there's suddenly huge amounts of displaced but very valuable users who are actively searching for financial institutions to plug into, and those people are worth a lot of money. So basically, everyone wants a piece of this pie and is looking for a way to get Mint users who are not interested in Credit Karma, or maybe are willing to shop around since their platform has been shut down, to come over to whatever platform it is, Money Monarch, Honeydew, Every Dollar, and so on and so forth. So that's why Mint Mobile is shut down. If you have been displaced by this financial shutdown, then I wish you the best of luck finding a new one. And let me know in the comments which ones you're interested in, and maybe I'll look into them myself. Thanks for watching.